me right now is Steve Kroll. He is from Monness, Crespi, Hardt Company. He's the managing director there. And Steve, it's good to see you.
Thank you, Maria.
Thank you so much for joining us. Is that a fair statement? The Fed earnings and the overall growth story is what markets are focused on, right?
100%.
How much is it election related?
A little bit the last couple of days, but I really think this correction that we're in right now started several months ago with the utility index breaking down, correcting almost 12%. It's rallied a little bit the last couple of days, but you had some very disappointing earnings on the industrial front. Honeywell, some of these really great companies that have found out that revenues just aren't there and the costs are up. So I think the Fed. It's interesting on the 10-year. The 10-year has gone up already 35 basis points, so it's done what the Fed's going to do. Remember, the Fed is only going to go from 25 to 50. The 10-year has gone from 138 to 181. So we've already had the increase. So that all combined has caused unnerving the market, and I think that this will continue a couple more weeks.
Meanwhile, remember yesterday in the Journal, Jeff Immelt said the reason that he wants to merge the Baker Hughes business, the energy business, with GE's energy business is because he's betting on an industrial recovery. You don't see that happen? No,
I don't. It may happen eventually. No, I just think we have a earnings report card that we do on companies, and it's really it's disappointing to see that industrials and autos and retail are not participating in this recovery the way they're supposed to. On the other side, the banks have continued to do better than most people expected. So we're getting real mixed messages from the economy. There's deflationary aspects out there. So we just think that after this correction will be over. It's not going to be dramatic.
You said deflationary, but core inflation last quarter running at the highest level it's been in 2 years, and wages were up 2.4%. And if the Fed's going to move once, maybe more, they're clearly concerned about not like plus 2% inflation, but inflation stirring.
Well, there definitely is, and you're seeing pockets of it. But you take the various industries. Retail, you have deflation in retail. Money management, you have deflation. Oil, you've had, it's come from 110 down to 38. Now it's rallying a little bit. Lately, now it's coming down. So
yeah,
we
45,
see
we're back up to 45.
45, right? So we see that the longer-term aspects that we're going to continue to have lower inflation than most people think.
What do you think's behind this economy that's sort of stuck in neutral?
I think people are concerned. They're frustrated. I think New York City is a good example. Sales tax, business taxes are down about 20%.
Tax revenue.
Tax revenue. So basically what's happening is that people aren't spending money, businesses aren't expanding. You're seeing more retail vacancies now than you've ever seen before. It's taking longer to rent stores.
Why? Regulation or just hangover from the last financial crisis? I mean, why?
A hangover. I think it's a sluggish economy, and there was some optimism at some point, but people are pessimistic now. I think the election has made people much more pessimistic on whatever side you are on.
And a lot of it's online, too, in terms of luxury retailing. Luxury retailing in the last few years has really taken off online.
Yep.
And small store owners and even some of these major retailers, these department stores here in New York City, they can't afford the rents based on what they're able to sell.
No, they're using the retail stores now as more like billboards. And you're right, online has really taken over in terms of all aspects, electronics, other goods, and hard goods.
Cheaper.
Yeah.
So we got the jobs number out on Friday. What do you expect, and what's sort of priced into the market, and how would you be allocating money right now, given that?
Well, I think the non-farm payroll number is going to be a non-event. I think that the thing to get through is all the earnings, and the earnings have been okay, but not what people are expecting. I just think that the market right now has a couple of more weeks of a corrected period here, and we probably will get to down 3% on the year. So that's another 4 or 5%.
Wow.
And I just think that you buy the good companies that have the good earnings and raising the dividends, but the problem is you're getting a game of musical chairs right now, so you're losing health care, you've lost industrials, you're losing, you have Chevron had a good number and Exxon had a terrible number. So it's really a case-by-case basis, and it goes back to the old days. I've done this 46 years of stock picking rather than all of a sudden saying the market's cheap and the market's not cheap, and it's a very difficult period. Most of our really good clients are not doing that well in the market, and that usually tells you that the market is unnerved, not the clients.
And so, final question here, real quick, on the election. Do you see a performance, can you predict? If Hillary is the president, what happens to the market? What happens if Trump wins?
It's hard to predict. I don't want to say what my prediction is. I switched from a Republican to a Democrat this year for the first time. But I think under Trump, short term, it will go down. Under Hillary, probably stay flat to down a little bit. It's very disappointing for everybody because we should probably have two better candidates. But I think the most important thing to the market is really earnings and buying good companies. And the Congress will have a check and balance on the political people going forward. But I still focus mainly on earnings.
Of course, that's going to drive markets.
Right.
And we know you're expecting a down market. Steve, good to see you.
Thank you.
Thank you so much for joining us. Steve Kroll is there. And be sure to